Hello friends, today we will discuss the basics of financial statement, mainly balance sheet and P&L. So to begin with, we'll start with asset. When we speak of asset, what should be the top three things that should come into our mind? First, assets have the capacity to generate in economic benefit. Second, asset talks about ownership, that somebody is owning that asset. Third, it is a measurement of cost. So, what is the definition of profit? Profit is a situation when wherein income of an organization is more than its expense. Note down the difference between we will see what is the difference between expense and expenditure. So when we have to calculate profit, we always see expense, not the expenditure. So how does uh, P&L statement look like? Profit loss statement look like? On one side is expense, that is material, cost of material, wage and salary, selling expense, administrative expense, and interest. And on the other side is the income, which includes sales, which is called the top line, and other incomes such as interest earned on deposit, dividend received on investment, and profit from sale of certain assets. And profit is called the bottom line. There are four possibilities of a transaction. Whenever a transaction happens, these are the only four possibilities of. First, either it would be expense or income or asset or liability. Expense and assets are called debit transactions, while income and liabilities are called credit transaction. Expense such as we give salary to employees, or buy assets such as we buy furniture. In both the cases, money is being spent, money is going out. Similarly, credit is something when money is some thing which when money is coming in, like when we are getting income, money is coming into our accounts, or when we are getting loans, the loan amount is coming inside our account. So how do we determine that money spent is asset or expense? Note, please note, we are using expense. We will come to the expenditure part later. Expense. It depends on the life of the item. Something that gets expense is something that gets consumed before balance sheet is made. That would qualify for expense. So, one small difference between balance sheet and profit loss statement is balance sheet is made on a particular date, like 31st December or end of a quarter. What profit loss statement is generally is made for a period of time, that is it is a accumulative figure. Now coming to the expenditure, when we talk about expenditure includes both assets and expense. Keeping this in mind, we come to this example. Let's take this example where few transactions are given, five transactions are given, like purchase of plants and machineries 5 lakhs, purchase of raw material 2 lakhs, payment of salaries 50,000, and sale or selling products we get 4 lakh rupees. So the total expenditure would be 5 plus 2 plus zero point 0.5, that is 7.5, while the income is the sale, that is 4 lakhs. So there is a deficit. It is a negative. It is showing negative bank balance of 3.5 lakhs. Now we have to determine whether it is a profit or loss situation. So the assumption, let's assume that 1.8 lakh of raw material is consumed and 0.2 lakh is lying in store. We know Some part of salary made in advance is an asset. Machine is an asset, not an expense. Suppose if the machine, building, or equipment get consumed, then it would be listed as an asset. It is not an listed as expense. It is not an expense, it is an asset, because as we have defined the criteria that something that gets consumed before balance sheet is made is called an asset, is called an expense. Let's say the machine will help earn 4 lakh rupees 10 times. So the depreciation would be 1 by 10 of 5 lakhs, that is 50,000 rupees. Now we write the PLN statement again. Expense is on raw material remains the same. Salary is 50,000, depreciation point 0.5, total 3 lakhs, sales is 4 lakhs, so the profit is 1 lakh. So we have ignored the inventory part. We will come to the inventory, impact of inventory later on. So we see here there may be profit in a case of negative bank balance. So is profit bad? Yes, profit can be bad when there is a deficient bank balance because of three situations. First, you have to pay bonus to the employees when you have profit. You have to pay taxes to the government, and you have to pay dividend to the shareholders. So, for a successful business, it should have both of these conditions. It should satisfy both these conditions: ability to generate profit plus ability to manage the cash flows. Now we will come to the impact of inventory. We will take three cases. In all three cases, the purchase, you can see the purchase sales, and purchase sales are same. What is different is the inventory, closing inventory. Suppose the in first case the closing inventory is 2, so 9 plus 2 11, purchase is 10, profit is 1. In next case, similarly, closing inventory is 3, profit is 2, and in case 3, case C, closing inventory is 4, profit is 3. So, how do we analyze this? How do we read into this? Inventory should be seen in conjunction to the purchase. C has C has consumed 6, taking profit 3. Highest profit because of lowest consumption. So we can conclude that higher the inventory, higher the profit. This concept is used to manipulate profit at times. So what are the different sources of fund? First source would be direct from the owners, that is the capital, direct contribution of the owners and the shareholders capital. Then is the reserve, that is the indirect contribution by the owners. Both of these combine together to be called net worth. Third is the loans. Fourth source of fund is creditors, from where you borrow goods. Creditors are those whom you have to pay for items purchased. So there are various requirements for working capital. First, acquire and maintain inventories. Second, cash and balance. When income are sporadic, expenses are continuous. Third is the debtors. If the client says payment will be made after, let's say, 60 days of delivery, organization must now possess the ability to sustain itself financially for another 2 months. So we can write balance sheet like this, and the sources can be caused as liability, we have already talked, and uses asset. So these are the four things: sources, capital, reserves, loan, creditors, and at the other side, asset side, fixed asset, working capital, includes inventory, debtors, bank balance. Now we will try to understand the concept of working capital. Capital, this is a transaction, this is structure given. Capital is of 300 rupees, reserves are of 200, 12% loan at the loan amounts to 400, creditor is 100, so it is 1000. So if the lender is expecting 12% with all the assurance, with all the paperwork, all the documentations, security of assets to fall upon in case things don't work, owner carries the risk of losses, deserves substantially higher return. Let's say a minimum of 2x, then it would be 24%. Similarly, reserves are the undistributed profit plowed into the business. It carries reinvestment opportunity, and has a possibility to earn a higher return. Deprived shareholders of the it deprives the shareholders of the opportunity of reinvesting the dividend. So it would be more than 12%. Let it be 15%. And for the creditors, let us assume it is 18% because generally it is 1 to 2% discount monthly. So we calculate the WACC in this way. Capital 300 at the rate of 24% is 72. Reserves 200 at the rate of 15% is 30. Loans 400 at the rate of 12% is 48. Creditors 100 at the rate of 18% is 18. Total would be 168. Adding all these would be 168. And the WACC would be 168 divided by 1000 into 100. 16.8. So we can conclude that investment should not generate return less than 16.8%. Now we'll take a case and we have to decide in which case to whom you would lend as a banker. The first balance sheet is like this. Let's see both the balance sheet first. Both the balance sheet have thousand asset and thousand on the liability side, and the fixed asset is 750, current asset is 250 on both the sides. So what is the difference? In the first in the first share capital is 450, reserve and surplus is 300, long term loan is 200, creditors is 50. While in the second, the share capital is 150, reserve and surplus is 100, long term loan is 650, and creditor is 100. Before proceeding further, we should know that what is good balance sheet for an equity investor may not be so for a lender. We will see the case of equity investor later after this. In this case, A's direct plus indirect contribution is 75%. Why do we say so? Because sh- share capital is a direct investment, capital reserves and surplus in the indirect contribution. So both contribute 750, that is 75%. So A has more skin in the game. As owner whose personal investment in the business is substantial is likely to be more committed to its success and more involved in its running. In case of A, owner's direct plus indirect is 75%, which we have discussed, while in case of B owes outsider 750. At distress sale, in case of distress sale, if the asset fetched lower than 750, which is very likely, the creditors of the organization may not recover their money. On the other hand, A owes the outsider only 250. So it is very clear that we will be lending A. Now we will come to the second situation of an equity investor. Where would you invest for two situations that are given? In both the cases, capital employed is 20 lakhs. While in the first case, the equity shares is of 100 each and the total equity shares amount to 15 lakh. While in the second case, total equity shares amount to 5 lakhs. In first case, loan taken is of 5 lakh rupees at 10%, and in case B, loan is of 15 lakh. We must say here that A and B are both similar in all the ways, identical in all the ways, like its functioning, manufacturing, operations, etc., management, etc. Let's assume profit before income, interest, and tax on capital employed is at 30%. So PBIT at 30% for both would be 20 into 0.6, 20 into 0.3, that is 6 lakhs for both. As A has taken only 5 lakhs, the interest would be 50,000. For B, it would be 1.5 lakhs. PBT for A would be 5.5 lakhs, and for B, it would be 4.5 lakhs. We can assume an income tax rate of 40%, and after deducting the income tax, we get the PAT of 3.3 lakhs for A and 2.7 lakhs for B. We should not jump up to conclusion now because we have to calculate the EPS, that is profit after tax divided by number of shares. When we do so, we find that for B, EPS is more. EPS for B is 54, while that for A is 22. Why is it happening? Because as we know from the calculation of VAT, owner's money is the most expensive. So that is the underlying concept here also. Owner's money is most expensive. B's average WACC is substantially lower than A. That is the other reason. That is all for now. We'll meet again soon. Thank you.